this whole US dollar experiment, this fiat experiment, has completely fallen off the rails, and we're just a banana republic who are not necessarily in the worst of it yet, but we're on our way to get there. And the world will see that and then back off the US dollar even more than they already are right now, and even more than they already have over the last few months and years. Imagine you were on a desert island for 20 years and then were rescued, or you were in some way indisposed for 30 years or so, and you came back to America, an American citizen. Here's what you'd be looking at. The average debt per US citizen is about $105,000. That's when you look at mortgages, credit cards, student loans, auto loans, which is not even taking into account the federal debt on top of that, which is about $38 or $39 trillion. And that puts another $106,000 of debt on every single US taxpayer, in addition to the $105,000 in debt that they have on a personal level. But then you also have the $103 trillion of unfunded liabilities, which is the biggest Ponzi scheme in the world, clearly in front of the eyes of everyone. We only pay the unfunded liabilities, which is why they're unfunded, by money coming in from new contributions from the younger generation. And when you take the expected GDP rate for the country going forward, it would take 100 years for the current GDP rate to be able to cover all of these unfunded liabilities. 100 years of the total production of the country just to pay down the debts, longer than a human lifetime. Just to pay down that aspect of the debt, longer than a human lifetime. This is why I always tell you guys, you don't need to know that there's $80 trillion in debt or $81 trillion. There's no difference. It's just an unpayable, unfathomable number from a system that's broken down because we've mismanaged it, misaimed it, and misused it the entire way since we used to have a good system until now. And as I've shown you on the chart many times, most recessions will start after the rates start coming down. And here's the chart. The recessions are in the gray area. And when rates start dropping, as they have recently, that's typically when a recession follows shortly thereafter. And the Federal Reserve is in a really tough position where they can either fight inflation or help the economy. They either punish the economy or they help inflation. They raise rates or they lower rates. There's no good outcome. There's always a bad outcome. It's which is the least bad of the two. And the most politically expedient and convenient will be to lower rates. What should we be doing? Doesn't matter. Rates are probably going to be lowered. That'll be good for things like gold. That'll be bad for things like the US dollar. And in addition to all of this debt, these different tiers and strata of debt, the problem is, and the way to fix it is, what we're going to talk about now, is when we have this operating deficit, or a budget shortfall, some may call it. The federal government had a budget deficit of $1.83 trillion fiscal year 24, meaning spending exceeded revenue by that amount. This is all from the U.S. Treasury fiscal data. The deficit represents an increase of $138 billion compared to the previous year. You can see here that the revenue that came in is $4.92 trillion, but then we spent $6.75 trillion. And right there, that is the actual breaking point right there, the actual trigger spot where everything could start to be fixed from right there. We need to bring in enough money from revenue that more than covers what we spend so that instead of a deficit, we have a surplus. So we're 1.83 trillion short for 24. We expect to be 1.9 trillion short for 25, with no relief in sight and no way that this is going to slow down at all. We've also got record delinquencies right now on mortgage debt, credit cards, record levels of margin debt. But in the fourth quarter, the percentage of debts that were considered delinquent, meaning at least 90 days past due. 90 days past due. Are they going to pay it on day 91? I doubt it. The percentage of people being delinquent right now was at a 12-year high in the fourth quarter of 2024. That's telling you part of the story that I'm trying to demonstrate to you guys. You've been told the economy is so strong for so long, but no one's ever stopped and said, yeah, but we did it all on debt. We did everything on debt. What they pretend was strength was just a moment in time where it wasn't so bad because we're just living off of the federal credit card as well. 11.12% of cardholders are making only the minimum payment on their credit cards. Expect the percentage of credit card holders who are only paying the minimum to only continue to increase from here. And one thing I tell you is that the worst thing for the stock market is uncertainty, and we could not possibly have more uncertainty than we do right now. And that's why it's a fool's errand to try and make any kind of profits or make any kind of moves right now, in my opinion. I think it would do you well to step back and observe and let things settle down a bit. Things are too uncertain right now to know to make a very wise decision. You can make a decision and it might pay off, but it's a lot harder to make the right decisions ahead of time when there's so much uncertainty and so many things that could go in a lot of different numbers of ways. It's not the time to try and make your 5 or 4% right now. It's a time to step back, plan what you're going to do, and then strike when you're going to make 30%, 100%. It's not a coincidence that the last read on the economy is actually a negative number. We're actually recessing in quarter one. Are we going to keep that up in quarter two? I don't know. It doesn't matter either. But we had a drop of 0.3% from an increase of 2.4% in the last read. Consumer sentiment slides to the second lowest on record as inflation expectations jump after tariffs. In another manifestation of the strength of an economy, it's about the lines of the food banks, the lines of the soup kitchens, how many people are homeless. And right now, lines at American food banks are getting longer and setting new records. In addition, we have all these bad market omens. For example, indicators like, the Buffett indicator, every time it goes over a certain level, it always is followed by a decline. But an even bigger indicator is that Warren Buffett got out of the market, just went to cash. Not totally, but a big portion of his money he pulled back and he put it in cash. And he's sitting on the sidelines with a big cash position. That's an indicator. And the Q ratio, which is risk if it goes above 1.0, is basically taking the book value or the value of all the assets on the market of the stocks you're watching, and then you compare it to the cost to buy those stocks back. It shouldn't be 1-to-1. The Q ratio right now is at 1.88. Anytime it hits 1.0 or higher, that always is followed within a number of years, not necessarily too long, with a pretty significant market crash. Not a 10% correction, I'm talking about 70%, 80% down. Historically, that's what's happened. Right now, the PE for all the stocks on the S&P 500 is 28.95, which represents a very expensive valuation across the board for all these stocks. And this is at a time when complacency has peaked. Complacency is very high, and I always tell you that a good way to look at it, the easiest way, you look at the fear gauge or the volatility index, the VIX, which you can see right now, it's at 17.24, and the lower this is, the more complacency among investors. They're not worried about things. If there's not a lot of fear on the fear gauge, it's because investors are confident and they're having faith in what I describe as the wrong leaders. You've got the plunge protection team. You've got jawboning among politicians. You've got Donald Trump saying that he'll get the markets to go higher, the rates to go lower. You've got Federal Reserve doing similar things to jawboning, saying maybe we'll have to keep rates longer for longer. You've got Janet Yellen, who was serious when she's talking about we'll never have another financial crisis in our lifetimes, and we've had, in my count, 1.5 since then. And she also was serious when she was pretending that you could have a coin made out of platinum and say it's worth $1 trillion and put it on the balance sheet of the Federal Reserve to give more spending space on the books. That is absolutely bad, crazy, loony town, crazy. And the entire world will see it, not just you and I. We see how stupid it is to say this piece of tree bark is now worth $128,000. And we put 40 of them on the balance sheet, so therefore now we can. It's all smoke and mirrors, and it's not that we're going to realize it. It's that other nation states around the world will see that as a moment where they've admitted that this whole US dollar experiment, this fiat experiment, has completely fallen off the rails, and we're just a banana republic who are not necessarily in the worst of it yet, but we're on our way to get there. And the world will see that and then back off the US dollar even more than they already are right now, and even more than they already have over the last few months and years. So what's the point of all of this? Well, I'll tell you something. Since things go really slowly when we're talking about this, all this economic stuff and financial concepts, it goes so slowly, and there's literally nothing you can do about it except for yourself. Prepare yourself to help yourself and the people that you care about. Besides that, taking actions for that bubble and vacuum of you can't really do much unless you're a politician maybe to change anything. So you can't do anything about it, and it's happening so slowly, all at a time when we are about to be in a recession, as I showed you earlier in the charts. But for any investor, I would suggest that you get involved right now with silver mining companies, the good quality ones. I try and focus on precious metals. I'd get out of just about everything else. A couple of specific oil companies, and even get into some of these very unloved and misunderstood industries that I explain in the Peter Leeds newsletter. And this is from the Peter Leeds app. Mark says he invested $11,000 and he made 55% in 20 days. Here's where we selected Opal Fuels, and I wrote back to Mark, I said, you're going to be glad to know it's gone up another 9% today. Here's a little bit of a weak cup and handle pattern. And through this period here is where it consolidated. You've got a big turnover of shareholders. It's consolidating. Newer shareholders are much less likely to sell. So as the shareholder base turns over, there's fewer and fewer sellers over time the longer it goes. And you can tell where there's a balance between sellers and buyers. There's a pretty good sideways trading range. That's a consolidation. That's gearing up to go even higher with a lot fewer people who are willing to sell the shares. It consolidated again here, and this is all leading up to this stock is going to go a lot higher from here, but it's already started to make its move. And congratulations to Mark and anybody who's a subscriber to the Peter Leeds newsletter. That was a pretty good, quick performer, which is just getting started. And I've got plenty of videos that you should check out where I'm telling you ways to prepare and survive and thrive through a recession. There's choices you can make today that'll make any recession a lot less painful for you and actually open you up to some pretty good opportunities too. And check out all these videos we got coming up really soon that these are concepts we're working on. That's why you want to subscribe to the channel so you don't miss out on any of these as we're putting them out as fast as we can. When we analyze and find for you really high quality stocks that are trading for less than $5 per share. They're still tiny companies with their best days ahead of them. And if you want me at your beck and call 24/7 by email, consider becoming a Peter Leeds Insider.